This villa in Dubai Hills estate made 140% capital gain in just 2 years. And there are many other examples when investors made 30, 40, 50% and even X2 in no time. Dubai real estate has been one of the strongest global performance since 2021. Prices surged, rent exploded, liquidity was instant, almost anything would work. Investors were buying floors, bulk units, villa clusters, many times having no enough liquidity to cover 100% of the price because the risk was awarded. Almost anyone would sell anything upon paying 30 to 50% of the total price with a premium. But I have a bad news. Those times are gone. Whatever worked between 2021 and 2024 will not work in 2026. Strategies that made money in the last cycle are usually the ones which will fail first in the next one. Because now the market has entered a different stage. It doesn't mean you should hold back and not buy, it just means that you need to align your expectations with the reality and choose the right property and the right strategy. In this video, I will break down which strategies that used to work before are now obsolete and will lead you to a financial trap, versus strategies that you should use in 2026 to minimize the risk and maximize your returns, and what property categories you should look at within the next 2 to 5 years. So let's talk about why old strategies no longer apply. Between 2021 and 2024, Dubai market experienced a post-pandemic rebound plus a global capital inflow shock. So what worked then? Buying almost any off-plan property, flipping before handover or even sometimes just in few months, relying on price momentum rather than on fundamentals. Accepting weak layouts, low floors, blocked views, high service charges just because anything would sell. Assuming that the demand will always absorb new supply. Those strategies worked because the demand was explosive, but this no longer exists. So in 2026, new supply is significantly higher, secondary buyers are more selective, developers are more aggressive, and incentives are slowly getting back. So where are we now and the market setup for 2026? Knight Frank notes that residential prices are now above the previous peak of 2014, a classic late cycle signal. At the same time, rating agencies including Fitch have warned that supply pressure could trigger a correction up to 15% in a downside scenario. However, it doesn't mean crash, it means that selection replaces momentum. Time to act not fast but smart. So old logic, it will appreciate anyway, I will flip before handover, payment plan makes it affordable, it's Dubai, demand will come. Now, new logic that you should use in 2026. Can this particular asset survive oversupply? Who will rent it in a flat or down market? If I cannot exit, would I be able to continue with my investment? So what to buy in 2026 using the new logic? So buy category number 1, prime and ultra prime residential properties. Luxury and ultra luxury buyers behave differently. This segment represents smaller buyers pool, asymmetric reaction to the market cycles, and almost no leverage. In 2026, prime is not about capital gain or flipping, it is about capital preservation. Unlike the mass market buyer who is price sensitive, for high net worth individuals, property in Dubai is not a lifestyle dream or a short-term gain, it's a strategic asset allocation decision. They typically buy without leverage or with very low LTV, hold diversified global property portfolios, think in 7 to 15 years horizon, not in 12-month flip, and they're not dependent on the short-term cash flow. Over the past decades, the number of millionaires in Dubai doubled. 2024-2025, Dubai saw the highest inflow of high net worth globally, ahead of the US and other traditional hubs. And it was ranked number 1 by new wealthy migrants inflow per year, and took the 7th place in the world by the number of high net worth residents. But the more accurate definition is asymmetric reaction to the market cycles. So during corrections, prime demand does not disappear, it pauses. What actually happens, speculative and mortgage-driven buyers exit, transaction volumes fall faster than prices, owners are not forced sellers, and best assets are just withdrawn from the market. As a result, corrections are shallower, price declines are limited, and the liquidity compresses, not the value. Versus during the growth phases, the reaction is the opposite and is stronger than the mass market. Global capital re-enters earlier, competition intensifies around limited supply, prime inventory cannot be scaled quickly. Off-market deals dominate, as a result price growth accelerates faster than the mass market. New heights are reached quicker, and the previous peaks are often exceeded in one cycle. Key structural insight: luxury and super luxury properties do not fall harder, they trade less. And when the growth returns, they move faster than the rest of the market. Buy category number 2, undervalued waterfront locations. apartments are oversupplied. They represent around 89% of the market share. If your strategy is capital gain but your budget is not enough to buy a family home, townhouse or villa, the only apartment area in today's market worth looking at is Dubai Islands. They have amazingly structured master plan, long-term infrastructure commitments, and the most important, they're not yet psychologically priced as conventional prime. Then why is it undervalued and what holds the buyers back? First of all, if the location causes a lot of debates, it's something that I would personally have a closer look at. However, what we often see among the mass market buyers is completely the opposite. They rush buying in the locations which are widely marketed and hyped up. By the way, I made a video about 3 of such locations, and this is where you can see the link. So in 2025, Dubai Island still remains a dark horse for many. The first reason for that is legacy risk, or so-called data problem. Dubai Islands is physically new, but mentally linked to the old area of data. For many global investors, data is associated with high oil density, lower income demand, and trading economy. What comes to mind is narrow streets, traffic, overpopulated low-key neighborhoods, data souks, labor accommodations, and so on. It's not associated with the prime residential appreciation. And it's not aligned with the Dubai luxury narrative they already understand. All of this creates a perception drag, even if the master plan is strong. Capital is usually conservative with unfamiliar locations, especially when the name doesn't yet signal prime. Second reason, comparison bias. Investors compare it to Palm Jumeirah, already mature, Dubai Marina and Downtown, which are globally branded. They conclude, why buy in uncertainty when I can buy something which is already proven? The next reason is liquidity uncertainty. Today, not eventually. In Dubai Islands, liquidity is obviously future promise, not current. So right now we have fewer comparable transactions, limited secondary market depth, exit is possible but not instant. For global capital, this raises one question. If I need to exit early, who is my buyer today? Until this answer is obvious, the capital allocates slowly. So Dubai Islands is not underperforming, but it's been priced by early cycle logic, while majority of the investors are stuck in late cycle expectations. However, you need to understand, all these fears and concerns are aligned with significantly lower early stage price per square foot. Waterfront and especially beachfront locations are extremely scarce. Here we talk about 1800 to 2600 dirham per square foot versus 3500 and above, and other established prime areas like Port de la Mer, Dubai Harbor, JBR, Palm Jumeirah, and Blue Waters. So Dubai Islands, in my opinion, suffers from timing friction, not the fundamentals. So it's too early for mass confidence, too big to feel scarce yet, too new to have a price memory, too long-term for short-term investors. And this creates an opportunity for long-term game smart investors. By the way, drop Dubai Islands in the comment section if you want me to make a separate video about the area. By category number 3, commercial properties. While residential properties faces supply pressure, commercial properties behave completely differently. While residential real estate is primarily a capital preservation and capital allocation asset, commercial real estate is primarily a cash flow and utilization asset. What works for commercial properties? Prime or near prime residential areas, scarce lifestyle-driven assets, areas benefiting from wealth migration, not leverage. Projects aligned with long-term demographic flows. What does not work? Generic office stock, oversupplied commercial zones, anything priced on short-term yield assumptions. So why spending $1 million on a grade A office in 2026 might be a better idea rather than buying 1 or 2 bedroom apartment in a prime location. Dubai prime office hubs are benefiting from flight to quality plus consolidation trend. Larger tenants tend to choose the whole floors, headquarter-style places, which moves demand into top-grade stock. Office spaces offer investors more control over the cash flow and more clear underwriting. You have more financially strong, economical cycles resilient, and less emotional tenants in comparison to residential properties, and fewer small-ticket vacancies. Cushman & Wakefield reports that overall Dubai office occupancy is around 92% and 94% for grade A office occupancy. And very limited new stock is expected to come in 2026. So market is expected to remain undersupplied of office spaces, with rebalancing more likely towards 2027-2028. So while residential rents started showing some declines, office rental prices showed around 35% annual increase. And of course it's driven by demand and very limited stock. And prime locations like Sheikh Zayed Road, DIFC, Downtown, Business Bay are leading. Knight Frank expects the performance gap to increase between grade A well-located offices and older secondary stock. In a cooling or selective microenvironment, this matters a lot. Grade A spaces tend to keep the tenants and the rental prices better. Companies providing business services represent around 38% of the demand in grade A offices. These tenants, consulting, legal, corporate services, prefer grade A offices and prime locations for branding, clientele access, and talent attraction. So the final part, do not buy list in 2026. You should forget this 2021-2024 plays, such as flipping only of planned strategies, mass market low to mid-ticket areas, and overhyped areas where the promised capital gain is already priced in. If it only worked while the market was rising, it won't work again while the market matures. And the final investor test. Long-term strategies always win. You don't make money unless you sell, and you don't lose money unless you sell. Buy and hold, get rental income, the best strategy for 2026. Demand and supply are the key factors for property market. Use leverage with caution. If the rent declines, will you still have zero or positive cash flow? Thank you for watching this video. If you still didn't subscribe, press that little icon to stay tuned. Your feedback and support is very important and motivating. See you in the next video.